to the Business of Property podcast. I'm Simon, and I've been investing in property for over 20 years. And if you're an active landlord or planning your next property investment, this podcast is for you. I hope you enjoyed this episode, and if you do, I would really appreciate it if you could tell a couple of other property people about the Business of Property podcast. Now, for this episode, in the last couple of months or so, I've had to remortgage one of my properties, one of my investment properties specifically. So this week, I'm going to share the details of the mortgages I considered that were available to me in this remortgage process, and how I compared them and sort of decided between them. There were quite a few different combinations to choose from. There were 2-year fixes, 3-year fixes, and 5-year fixes to choose from. There were also tracker options, although I ruled those out fairly rapidly because those rates really are quite high, and to be competitive with the other mortgages, they'd have to, the base rate that they're tracking would have to come down quite a lot. There I suppose, is also the option of leaving the mortgage on a standard variable rate, but that really did not seem very attractive. That standard variable rate being around 8.5% at the moment for this particular mortgage and mortgage provider, and that would have very much made the mortgage payments more than the rent, which really wouldn't have been good. So that wasn't an option. So I was looking at the fixes really, and I decided to rule out considering 3 years just because there were too many different combinations to look at really. So I was looking at 2-year fixes and 5-year fixes really. Now, within each of those time periods, there were a further 4 choices to look at and try and consider and compare. And each of these had a different interest rate and fee. So as sort of different combinations or comparisons. So I am just going to quickly list them. I know a list of numbers probably isn't great audio, but I want to give you an idea of the sort of ranges involved. So under the 2-year fix umbrella, the lowest rate was 3.59%, and that came with a 3% fee. Now, this mortgage was remortgaging was just over £200,000 of mortgage. So that 3% fee worked out at about £6,200. The next step up was a 3.84% interest rate with a £3,995 fee, so effectively £4,000. Up again, 4.39% interest rate, and now the fee was down to £1,495. Then the final option was 4.94% interest rate, but a £0 fee, so no fee at all on that one. So that's the 2-year fixes. So now the 5-year fixes, 3.74% interest rate is the lowest available there. And that again had the 3% fee, so about £6,200. The next step up, 4.04% interest rate. And again, that one was about the £4,000 fee. Up again, 4.19% interest rate with the roughly £1,500 fee. And then the final option with no fee at all was 4.44% interest rate. So what did I do to try and sort all of this out and arrive at the best option for my new mortgage? Well, I had a quick look around for tools that might help to calculate these things for me, but I really couldn't find anything that covered the complexity required. And if you think it's not that complicated, keep listening and let me know if you still think that by the end of this episode. Some of the things I really wanted to know was what is the monthly cost, but in cash. And if you're considering the cash, you have to consider the tax as part of that as well. And of course, calculating tax on rental properties, I should add actually, this property is owned in my personal name, so it is affected by Section 24. And because of that, calculating the tax really isn't simple. So that on its own is quite complicated. But then I also wanted to think about the total cost of the borrowing. But if you're trying to compare sort of 2-year products and 5-year products, of course, for the 2-year one, you have to sort of work out some way to extend that, so that adds extra complications. And then, of course, you've also got to add in the fee and the interest as well to work out that total. Then you can sort of combine these things to work out your net position, considering the money that's effectively come out of your property because it's been added to your mortgage, and the money that you've managed to keep in cash flow along the years. So I don't think it was straightforward, and my spreadsheet tends to agree. So that is exactly what I did. I made a spreadsheet. And I would volunteer to share this spreadsheet with you, but it's currently a bit of a mess, as you might learn as we carry on through this episode. However, if you're listening and you know of a tool that helps to do this in a more simplistic or approachable manner, then please let me know. You can reach me on show@thebusinessofproperty.com. Or maybe if you really think that I should actually put in the time and effort to make a tool, or maybe just to tidy up my spreadsheet and put that into a shareable state, then again, let me know. And maybe if enough people email me, maybe I'll be convinced to sort that out. Again, show@thebusinessofproperty.com. For now, though, I'm going to talk through at least some of the spreadsheet that I ended up putting together. And to sort of give you a quick overview, well, I say quick, this may not be that quick, but to give an overview of what the spreadsheet does, deep breath, it adds the fee to create a new balance. So it adds the fee to the current mortgage balance to create a new balance. Then using that, it can work out the annual and, of course, the monthly interest amounts based on that new balance of the mortgage and the relevant interest rate for the appropriate product. And from those, we can calculate the total cost of borrowing, although it's spread across a sort of almost invisible cost that's been added to the mortgage and the cash that actually leaves the bank account every month in interest payments. So they are slightly difficult to really total and compare, but anyway, we're trying to look at that. And those two things have different effects on tax. Because of Section 24, it's not all that obvious either. Specifically, in the first year, the fee will be recognised as a finance cost and will qualify for 20% tax relief, even though I haven't actually paid any of that cash from my rental income. It has still been an expense to me, and it does happen in that first year. It happens immediately as you remortgage. So that actually serves to reduce your tax bill for that year, because you qualify for the 20% tax relief on that finance cost without the cash having actually gone anywhere, which is all very strange. But anyway, now after I'd sort of worked out that initially, the next problem is you need to try and compare 2-year against 5-year. And in order to do that, you have to work out what you're going to do for the other 3 years after the 2-year fix. So you have to make some assumptions. And apart from not really having a clue what the mortgage market will actually look like in 2 years' time, I don't think anybody can really tell you that. We can all sort of make some educated guesses, but no one is really going to know. So whatever it is going to look like, there will probably be a whole heap of potential options again. You could remortgage onto another 2-year fix, or you could remortgage onto a 5-year fix at that point. And at this point in time, I'm considering 8 different possible remortgage options. And if I took those 8 options and considered each of those as the next step after each of the 4 2-year fixed rate mortgage options I'm currently considering, then obviously that would sort of balloon the number of options that I'm considering quite significantly. And having done that a little bit, making my spreadsheet a bit of a mess, I actually am not going to sort of try and consider or explain all of those different combinations in this episode. Instead, I'm just going to consider a fairly sort of middling estimate for remortgaging onto a 5-year fix after the 2 years. So that 5-year fix will then cover the remaining 3 years. And I am going to then sort of cut it short, which isn't still isn't an ideal comparison, but it's what I've decided to go for this particular spreadsheet and this particular comparison, and we're just going to have to live with that, because otherwise this episode will last for far too long and be far too complicated. It's probably already too complicated. Let me know what you think. But with those assumptions and that sort of categorization in place, let's start looking at some of the results. Well, initially, we can look at a sort of 2-year snapshot. So this is, again, not really a fair comparison, because the 5-year fix is designed to last for 5 years and you're trapped in it for 5 years, or you've deliberately opted into it for 5 years. Perhaps it's not a trap. And hence some of the effects of that don't really work after just 2 years. Because you've got that lower interest rate on the 5-year versus the 2-year, it hasn't had the full effect or the full chance to sort of balance things out in just the first 2 years. So it's not the most straightforward of, or not the most ideal of sort of comparisons, but we have to make a comparison. We have to base our decision on which mortgage to go for on something. So the 2-year snapshot results. For the cheapest 2-year fixed rate interest rate, so that's the 3.59%, with the highest fee, £6,200-ish, it ends up being that your total finance costs across those 2 years about £21,500. As I said before, this is on a just over £200,000 mortgage, so that's where the interest amounts are coming from, and of course in this case the percentage fee amount as well. And across those 2 years, the after-tax cash that you actually get to keep is about £9,600. However, of course, our loan has increased, so you could take that loan increase off the sort of cash that you've got to keep to give a sort of net position. And this is slightly distorted because, of course, the loan amount is in the mortgage and the property. You don't actually have to realise it at this point, but anyway, net position 3,400-ish. If you step up, then in this particular scenario, the total finance cost goes down a little bit, so from 21,500 to about 20,200, and the after-tax cash you get to keep has gone down a bit as well, so from 9,600-ish to 8,500-ish. However, when you combine these things with the loan increase, your actual net position has improved a bit. So you've gone from £3,400 to £4,400, in fact £4,500 nearly richer. So this is sort of how much your wealth has changed by over this time period. Step up again, so we're now looking at the 4.39% 2-year fix and the £1,500 fee. Total cost of borrowing, a bit lower again, 19,800, and the cash has gone down again, £6,300 is all the cash you get to keep. But ultimately, your net position has improved slightly, and you're now £4,800 better off when you combine the change in the loan you owe and the actual cash you've ended up with in your bank account. You take a step up again to the most expensive 4.94% 2-year fix, and you're actually now a bit worse off, interestingly. So your total cost of borrowing 20,400, and the profit gone, the cash you end up with after tax has gone down to 4,300 or so, and that means your net position is also about £4,300, which is less than the £4,800 from the previous one. So it's not a clear picture. And when we compare this across the 5-year fixes, as I said, it's very complicated, or very unfair, not so much complicated, it's just unfair to compare the 5-year fixes at the 2-year point, really. But the total finance costs on the 5-year fixes range from 22,100 all the way down to 18,400-ish. And in this case, the best option from a sort of total wealth change, the sort of net position you end up with, is actually the one with the highest interest rate. 4.44% and no fee would increase your net position by nearly £6,000. And of course, that one at this point is actually better than any of the 2-year fixes. However, you're also then forced into that interest rate for the next 3 years afterwards, when with the 2-year fixes, you're hoping to remortgage onto a lower interest rate. And that is, of course, what we then assume to then carry things forwards into the 5-year sort of snapshot at the end of the entire process. Now, I know there's lots of numbers here, and I'm afraid there's going to be a few more numbers now, but I'll try and sort of simplify it and just give you the best and worst sort of situations or ranges of things, rather than reading out all of the numbers for you. So at one extreme, you've got the starting on the lowest interest rate 2-year fix, so that's 3.59%, with the highest fee, £6,200. And here, the total cost of the finance and the borrowing and things, the interest, etc., is nearly £48,000. So 47,800 is about the amount. And that's quite a lot higher than any of the other figures here. However, it also gives you the highest amount of cash in your pocket after tax, at just over £21,000 across the 5 years. And because you've got the much higher borrowing costs, it actually ends up being a relatively low net position, a low total wealth increase over the 5 years. You're looking at a total wealth increase of only around £13,400, which is actually the worst of all of them. So it's got the highest finance costs, and from that, the worst end position you're going to end up in, but you get to keep the most cash as you go along. Now, I'm going to ignore the highest interest rate 2-year fix with the 0%, with the zero fee on it, because that one doesn't come out so well. Instead, I'm going to compare to the 2-year fix at the 4.39% interest rate and the £1,500 fee. And this one, the total cost of finance and borrowing and interest, etc., is £45,500. So it's quite a chunk cheaper than the other one I was just talking about. You only get to keep £18,200 of cash after tax over the 5 years, but you end up with the best overall position result, with an increase in sort of your total holdings of about £15,200. So that's the 2-year fixes. So how do they compare with 5-year fixes over that same time period? Obviously, don't have to assume anything about what you're going to do for the last 3 years in a 5-year fix, because the 5-year fix is fixed for 5 years and it's already decided for you. It's preset. It's just there. So we can just work out the figures. And here again, it's a bit of a mix as to whether you want to increase the cash you've got in your bank account as you go along, or whether you want to maximize your total net benefit over the period. And now, in the 2-year snapshot, the zero fee one was looking good. But actually now, if you're maximizing for total increase in value, total increase in wealth, that's no good anymore. Instead, you're looking for the next two top ones. So we're looking at a 4.19% interest rate with a £1,500 fee. And we end up with a net wealth increase of £15,500. And this is actually the best of all of these sort of scenarios. Of course, I'm taking a sort of middling estimate on what happens to the remortgage after 2 years in the 2-year fixed scenarios. And if we're more optimistic, if we think we're going to have lower interest rates than I've used here after 2 years, then it's not difficult to reverse this and actually make the 2-year fix look better. But I've deliberately gone for sort of a middling forecast in order to sort of try and be realistic rather than overly optimistic. And this is how it turns out. And the 5-year fix actually looks very slightly better just by a few £100s. However, if we wanted to maximise our cash over the 5 years, after-tax cash, and accept that we were going to be slightly less well off overall, because we've increased the borrowing that we've got against the property, then the best 5-year option would be the one with the lowest interest rate, 3.74%, £6,200 fee. We'd end up with about £21,000 of cash after tax over that time period. So it's almost exactly the same. It's actually just a few pounds less than the 2-year scenario. And the sort of net position, though, would actually be a bit better than the 2-year scenario, because we haven't had an extra fee when we remortgaged again after the 2 years. And that's sort of fed into helping that. So we've got £14,800 of net wealth or positional change over those 5 years. So lots of numbers there. And ultimately, they're actually all really very similar. So I think my kind of conclusion after putting in quite a few hours to producing this spreadsheet is that on a £200,000 mortgage with borrowing costs across 5 years of nearly £50,000, it might be possible to effect sort of your end position, your end wealth increase over those 5 years of owning and renting out this property by around £1,000 to £1,500. And, well, £1,000 to £1,500 is not to be sniffed at. Compared to the value of the property, this is a £200,000 mortgage on a roughly £400,000 property, and the total cost of borrowing around £50,000 over the 5 years, £1,000 to £1,500 either way doesn't really feel like all that much to me. So I think perhaps the bigger choice in these products is probably, do you want to move a bit of money from your property into your pocket, in your cash flow, effectively by extending your mortgage without actually remortgaging with a mortgage extension, which basically isn't possible on this property because it's in the southeast, and the rental cover requirements and things like that just wouldn't allow it. So while it might be possible to extend it very, very slightly, it's not really a feasible option at this point in time. So this sort of moving the money around by having the higher fees and the lower interest rates, and hence more cash in pocket after tax, it is effectively a way of just very slightly extending a mortgage. And I think really that's a decision that, rather than necessarily trying to guess which mortgage product and whether 2-year or 5-year fix is going to work out best for sort of overall wealth, the figures there are very small, and it's actually very easy to push around the 2-year and then afterwards remortgage sort of end result with relatively small changes to the predicted remortgage interest rate after 2 years. There's just not much in it. So yeah, it's a very complicated set of circumstances to try and analyze. And ultimately, I'm not sure that there's very much result, except perhaps deciding whether you want to have a bit of a shift of money from your mortgage into your pocket. And the sort of rough rule of thumb for that is to actually go for the higher fee and the lower interest rate if you want to move money out of your property via your mortgage into your pocket, or if you're not fussed about maximizing your cash flow at the moment and you want to instead maximize your total wealth gain, then instead go for the lower fee and higher interest rate, although possibly not right at the top with a zero fee. They don't seem to quite work out as well. So ultimately, what did I do? Well, I went for sort of the middle of the road. So I actually decided not to go for maximizing the cash flow or to go for maximizing net wealth. And I actually went for a 2-year fix at the moment of the the 3.84% interest rate and about £4,000 fee. So if I'm still here, and if you're still here in 5 years' time, we can find out whether that worked out or not. But it's definitely not my recommendation for anyone else. Everyone does need to consider their own personal circumstances and perhaps put together a spreadsheet and work out what was going to be best for them. And indeed, the mortgage options that everyone's presented with will be different for every property and every situation as well. So you always need to do the analysis yourself. Right, there were lots of numbers in this episode and lots of different sort of ideas and thoughts and things to consider. I would really appreciate your thoughts on all of this. Please do email, let me know, show@thebusinessofproperty.com. And thank you very much for listening, and I'll be back again next time.